What's up, guys? It's Rob Beardsley with Lone Star Capital, and today I wanted to ramble about an interesting topic, which is trust, and specifically trust within partnerships and trust within syndications. And something that we've experienced recently and something that I'm understanding better and appreciating is the fact that you can't structure for trust. You cannot replace trust with a partnership structure. You can't build a certain preferred return or a certain hurdle or levers in the deal that build trust. At the end of the day, if trust doesn't exist, there's nothing you can do in the deal to replace it. So trust is the number one factor. And if it is missing, all the other negotiation points in the conversation are moot. So I would personally start with trust and then start building those partnership structures that fit you and your goals. If you and your investors, your fund, whatever it is that you're managing, need a certain preferred return or need certain return hurdles or want certain protections, that's fine. But if you're looking for those protections in lieu of trust, I don't think that works. And that's going to end up blowing up either early on or down the road on both sides, investor or sponsor. If you're not building trust, then I think the relationship is not going to work out. So from the sponsor's perspective, obviously trust is huge. You're acting as a fiduciary, you're taking capital, and that's pretty self-explanatory. On the investor side, I think that's less talked about. I think people are always just chasing equity and they're looking for investors looking for money, and they don't really stop to think about the partnership that they're establishing, the precedent that they're establishing, and who they're actually partnering with to get that money. These are very long-term decisions. So if you strike a deal with a certain investor to buy property, that might be a 2, 3, 5, 10-year long relationship that you're getting into. And as they say, you date your lender, but you marry your equity partner. Just because your lender may have a relationship with you over a 10-year deal, it's not quite the same. The relationship with an equity partner is much closer and has much more risk of fraying if things aren't aligned and don't remain aligned. So I think that's something really interesting and something that we're learning, honestly, as we deal with more investors, more equity partners, rather than just seeking equity from anyone who has it. We're starting to appreciate the nuances of certain partners and what they bring to the table aside from just the capital and how they are to work with, because you have to work with them on a day-to-day or week-to-week basis. And you want an investor that's understanding, you want an investor that supports you. And for us, we love investors that are savvy and can teach us something. And that's why we really do enjoy working with sophisticated family offices, private equity that have more experience than us. And they come to us because we're hungry, we're finding good deals, and we're honest and transparent. Again, it's that trust factor. So if it's a match both ways, I think that can lead to a very prosperous relationship. As a sponsor, rather than trying to put up your guard or negotiate on terms or make a case for why you have certain experience or why you should be treated a certain way, I think approaching the relationship more openly and more honestly will lead to a better relationship and a more likelihood of striking a deal. Thanks for watching.